There's also a labor shortage. So the labor force, obviously, here in the United States is much smaller than it was. We all know that people are raising salaries to try to get people to come back to work. They're turning off the bonus unemployment early in some states. We're here in October. This is all supposed to be turned off by now. So I guess I'll start with you, Chamath, in terms of the markets here. What do you think is happening? And is this an acute risk or just something that will pass?
I think this is where I think I kind of generally disagree with the market. I think that most people are under the impression that these are short-term kind of contractions and expansions, and that this is just a thing that needs to get worked through the system as we readjust to a post-COVID world, blah, blah, blah. I think it's different. And the reason I think it's different is if you just look at one thing and one thing only, which is that we have a massive labor shortage in America. And there's an incredible stat that I saw, which was the average hourly earnings of non-manager people in hospitality and travel. And the average salary, the mean salary was around 20 some odd dollars an hour, and it's now 33 bucks an hour. And so what that to me says is that we are going through a really sustained period where you cannot get people to do the work that needs to get done. Biden had to call the Port of LA and try to get these guys to be open 24 hours a day. The president of the United States is calling a local port, trying to get it to stay open. But why can't they stay open? Because you have longshoremen, you have all these unionized folks who will expect to get certain levels of compensation, which they deserve in order to do that work 24/7. But then all of that is going to get put through the system. And if you still have millions of jobs that needs to get done in order for the economy to function, the only efficient way that that's going to get resolved is by raising salaries. And those are consistent and persistent. Right? Those things are not just like, oh, you know what, I did say 50 bucks an hour, but now I'm taking you back to 25.
Yeah, you can't take that back. That's going to be, so
yeah. That's one thing. And then second, so there's people, right? So labor capital, I just think it's getting more and more expensive to get folks to do work. And then there's the raw materials that you use to make anything. And everything that I see is that stuff is going bananas. And so I put these two things together and I'm like, I think this stuff is here to stay. I'm really kind of a little bit of a, and I had not worried. And you can see in every episode before this, I was always consistently like, there is no inflation. You can fade the inflation trade. And now I'm kind of positioning myself to hedge myself in this situation.
All right, Freeberg, we've seen the pictures of the Long Beach and the Los Angeles ports. There's just ships out there, like I think 70 or 80 is where it peaked at in July. I don't know, have the latest data here of when it updated. But is there not a silver lining here that if people are making more money, then we're going to increase the size of the middle class and we're going to increase upward mobility? And that is a double-edged sword. It's great that we increase the middle class, but then they're going to want to buy stuff. So if people are now making 35 bucks an hour and they were making 20, now they got more disposable. Now they're going to go on Amazon and buy more stuff, and it's going to accelerate this problem, is it not?
The challenge is the rate of change. This is what the Fed tries to manage, and there's a White House Economic Advisory Committee that's involved in trying to figure out what's going to happen here. Because the current estimate is it's going to take at least a year or probably a year to work through the current logjam in the global supply chains. And during that period of time, as Chamath points out, what's happening is the cost for goods is climbing because people have to charge more because there's limited inventory and people are bidding up the value of that inventory. As they do that, the businesses end up needing to get more labor, and so they have to pay more to hire people. If they pay more to hire people, those people end up demanding more. And the cycle can actually go the wrong direction, where you have an inflationary spike that persists. How do you taper that inflation? It's not necessarily great for economic growth if you can't produce the stuff. And it can actually cause these runaway kind of effects in the dynamic system of supply and demand when you have these things clogging up the system for supply. So it is a real risk, and it is the biggest thing that the White House, this economic task force, is kind of trying to figure out right now. Is where's the balance lie where you can, basically try and taper this inflationary effect that's being caused by this logjam in the supply chain without causing economic disruption by raising interest rates. And so it's a really kind of complicated, second and third derivative formula that needs to kind of be resolved. And that's why so many of these little elements are so important to get right.
By the way, central bankers around the world have raised rates. The only place that hasn't gone up is Europe, ECB, and the United States, the Federal Reserve. So, and let's be honest, Europe and the United States, we absorb labor and materials from all around the world, right? We are the net importers. We are the net ultimate buyers of last resort of all of these things. And so if you're seeing inflation in those other, supply-driven economies, they are going to come on shore. They're going to hit us in the face. I think prices are going up.
The other free market argument that could be made is that these current trends will accelerate a trend towards more automation of low-cost labor. Because it now will make sense for businesses to invest in the capital, in the capex, in the infrastructure, and ultimately for technology companies to build that tooling to support that infrastructure that will automate jobs like working in fast food, like doing local delivery, like doing factory assembly, like moving things across the country in trucks. So self-driving trucks. Factory automation, biomanufacturing, additive and 3D manufacturing, and 3D printing. These are all industries that could benefit from the fact that labor now for kind of, traditionally low income work has gotten so expensive that it starts to make sense to switch to the technology alternative, which historically may have been too expensive, but now starts to make economic sense to businesses. And so there's a number of these automation industries that may significantly benefit, and that ends up ultimately being deflationary and the market comes into balance. So that's another way to kind of think about the macro on what may play out here.
There's a bigger risk here than just inflation. I mean, there's also a risk of stagnation or stagflation, because it's not just that prices are going up and workers' wages are going up, which could be a good thing, but goods and services just aren't being produced. So, I mean, I know, like my own experience, I recently ordered a Tesla. When I got a Tesla a couple of years ago, like I got it in 2 weeks. It was like almost instant. This time, they wanted me to wait 2 months, and I just got an alert that it's going to take 2 more months beyond that. So we have no idea. And if Tesla doesn't get most of the money, I don't think, until I actually take delivery of the car, right? That's when you make final payment. So now they can't book that revenue and those earnings. And Tesla isn't even the car company that's most affected by this. The big, traditional American auto companies like Ford are even more affected.